In equities, I'm slightly short, and I expect to stay short or add to shorts when opportunities arrive on all the bounces. And I'm looking for entries on the long side, sometimes in the summer period.
Thanks for joining us for part 2 of our interview with money manager Felix Zulauf. If you haven't yet watched part 1 of our discussion with Felix, in which he outlined his rationale for a coming epically volatile roller coaster ride in the financial markets, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Felix and I, as well as our partners at New Harbor Financial, share in this video. And please take just a moment to support this channel by first liking this video and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Doing so will help this video reach a lot more viewers. Okay, let's get started watching part 2 of our interview with Felix Zulauf. Let's look at maybe the next 6 to 18 months here. So the next half year to year and a half. We've got a projected potential 20% plus market correction. And then we have more inflation coming back and asset prices having one last, year plus run ahead. So what are the assets that you're looking at most closely right now that you think will do well, both in the 6-month sort of decline and then the boom after that?
Okay, I think I'm not a gold bug, but I think gold will move in the next 2 years in a range between 2100 and 1700. And I said to our subscribers that by late this quarter, we will most likely have a buy signal for gold and silver. And I think if you can buy silver below 21 and gold below 1750, then you have a great chance to make a good return this year. I would expect gold to trade back up to about the former high, which was 2075 or something like that this year. After that, I think it will fall back again. Silver could do much more on the upside. It could go to 35 this year. So you could probably make 50% this year in silver. In equities, I'm slightly short. And I expect to stay short or add to shorts when opportunities arrive on all the bounces. And I'm looking for entries on the long side, sometimes in the summer period. And I would suggest that you buy the old darlings again, like the Microsofts and the Googles and all that. But you also have to buy the cyclicals and the commodity related stocks, the metal producers and the mining stocks and the energy stocks, and those, because of what I said before, oil could then run from 50, 60 to 200s. And I think that is going to be the second move up in the new commodity bull market. Commodities have been in a bear market from 2008 to 2020. So for, or even 20, for 12 years, we are only in the second year of a new secular bull market in commodities. And the first run up is almost over. I think we are in the last inning here on the commodity on the first run up, and then see a correction into summer. And in that correction, you have to buy the commodities again, be it the metals like copper and zinc and those, and oil. And you have to also buy some of the agricultural commodities, because unlike the crowd who believes that it's getting warmer and warmer, I think the next 30 years it will get cooler, and we have high volatility in temperatures, and we have droughts in one areas and rains in other areas, and this damages harvests, and therefore we have a supply problem there too, and we have relatively low inventories also. So I think this run, the next run in the commodities, will go hand in hand with a declining dollar, and the capital will try to flee the US dollar, the currency, the fiat currency, into real assets, and it will go into commodities. And therefore, the whole commodity arena will be very exciting in the next 2 years.
Okay. I just want to pull on one thread here. Heard that argument before, understand it, actually personally believe in it. I'm just curious if the commodity complex is having like a really nice, phase 2 run. Why did you think that gold would go down in that environment, if I heard you correctly?
Yeah, gold has not really corresponded with the money printing efforts of the central banks. That has been a big blow to the gold bucks, because everything that happened, if you told the gold buck 20 years ago, he would say gold would be at $5,000 or $8,000 or so, and it didn't happen. I think it didn't happen because of the cryptos coming into play. They took the cryptos were eating part of gold's lunch.
Mm-hmm.
That's one point, and the other point is that all the other asset classes like stocks were working so well, and that's why nobody had a reason to go to the hedges, the gold, and I think, there is an 8-year cycle in gold, and the theoretical low is 24. So I think from 24 to 28, you will have a tremendous explosion in the price of gold. And that goes together with a decline in the stock market that I see, and the problems that we talked about before. So I think at that point of time, money flows into gold to hedge against all the unpleasant happenings, events that are materializing at that time, and then you want to own gold, and you want to own the gold miners. So that's why I recommend that you accumulate the gold miners here until early second quarter, from here into second quarter on weakness, and you build a portfolio, and you can run it and hold it to 28. I think you will make manifold your money on the gold miners. So I think it's going to be the outside investment asset against declining equity prices at that time. But it's too early for the big run yet. The big run in gold will come when the big run in equities is over. Right?
And all that capital needs to go somewhere. Yeah, exactly. And we'll be frightened and seeking a safe trade. Okay, great. The one asset class, but actually two asset classes I'd love your thoughts on. Maybe you already showed your hand on one, but bonds and real estate. I think for real estate, you said you think it's actually going to take a pretty sizable hit, maybe like a 40% plus hit in the bust coming after 2024. But how about bonds between now and then?
I think bond yields, so let's say 10-year treasuries, are close to a high. I expect a high late this quarter, early next quarter, around 2%, maybe 2.10. And then I think it will go down to 1% again into late summer or fall. A big decline. And that's it. From there, bond yields go up until 24. And then we will see whether the US is still the
cleanest shirt in the dirty laundry basket.
Whether it's still a clean shirt or not. So bond yields will rise from late this year through into 25. Yes.
Okay. And Felix, I've got to ask this question because you mentioned it. You've been investing for a very long time. As I said in the intro, you're actively investing billions of dollars worth of capital right now. So you don't have the luxury of just having an opinion. You actually have to have conviction and have it back whatever allocation decisions you're making with your capital there. What is your current opinion of the crypto space?
Quite frankly, I understand it theoretically. I do not have enough faith to have a position.
Okay.
My son has a position in it. I feel that I always felt that way, that at some point the authorities will try to block the cryptos and declare them illegal. And that is the big risk out there. You know, I cannot tell you when that happens. If it happens, I cannot say. I'm just too old for the crypto. I think the millenniums, you know, they buy cryptos. I prefer gold. And I can see that Bitcoin has a run from somewhere into 24 to or 25, from 35,000 to a few 100,000. You know, I can see that. I understand that this could happen. I do not have enough faith to put my money there.
Got it. Like I said, it comes down to conviction, right? And it sounds like you're saying, given your experience, exposure, knowledge of the space, you just personally don't have the conviction there. All right. And I realized I skipped over my other question I asked you earlier about real estate. Any thoughts on how real estate will perform between now and then the perhaps big bust you expect for that?
Well, it obviously depends on what real estate and where real estate and what location in that geographical area, etc. In general, I think real estate will continue to do okay for the next 2 years. But I think as bond yields begin to rise, the problem will begin to hit the real estate market, because real estate is financed by debt, a lot of debt. Mm-hmm. And if debt becomes more expensive, it hurts that market. And that market is full of excesses. As I explained, it's probably 40% overvalued relative to rental income. And therefore, usually when you have a decline, it declines to below rental income, you know. And therefore, I would be cautious. I own some commercial real estate, some office real estate, some residential, and the residential is really vacation homes. They are doing fine. They throw off good cash flow, and they are going up in price if you have them in the right location. But I think, and I will hedge that by short selling real estate stocks. Right.
Well, Felix, look, thank you for being so specific here with your calls. I want to end here with one sort of very high level question, which is you talked about when this sort of the unwind happens after 2024, you see a lot of economic pain. You said, it could be like a three-year bear market where, prices go down 50 to 80%. I think you said perhaps a generational recession. And you talked about a lot more sort of state involvement, state coming in to, address the crisis. And as part of that, I think that means we're giving up as individuals more control to the state. In both our lives, our freedoms, our money, et cetera. I see you nodding as I say this. To a lot of people that doesn't sound like a super fun future, and it may be just it is what it is, right? But what do you have any general advice or perspective to offer to today's person in terms of like what behaviors or strategies are going to help somebody navigate that type of future best?
Well, it always helps to have a great pool of savings on the side from which you can draw. But you're right, the biggest risk and the one I fear the most is we lose part of our freedom, our individual freedom. We are moving into a world with much more control. And at some point of time, people are unwilling to accept that. And then we could have a social revolution, and a revolution against the ruling class, the political class, and the ruling class, and the elite of the system. And I cannot forecast how this will end, but I think that is the risk, that we go into a period that leads to a sort of a social revolution. And that's no fun either. So stay a little bit on the sideline and do not try to fight in the front line when that revolution happens.
All right, a bit of the gray man strategy there. All right, Felix. Well, look, thank you so much. Like I said, there's so many questions I would have loved to have gotten to. We just didn't have time. And you've made so many specific predictions about what's happening in the future. I'd love to have you back on again when events develop a bit further down the timeline to get your latest thoughts on your next detailed vision on what's going to happen in the next part. So hopefully we can have you back on again.
It would be a great pleasure, and thank you very much for having me, Adam.
Well, it's my pleasure, Felix. And for people that have enjoyed getting to know you on this interview and would like to follow you in your work, is there any place they can go?
You go to our webpage, felixzulauf.com, and there you can get all the information you need.
Excellent. We'll put that URL up on the screen when we edit this. Well, again, Felix, Excellent. Thank you so much. It's been wonderful talking to you.
You're most welcome. Thank you very much, Adam. Bye-bye.
All right. Well, now's the time of the program where we bring in the lead partners at New Harbor Financial to comment on what Felix said, and as well as talk about the recent market action. Mike Preston is away for the week, but we've got John Lodera here. John, wonderful discussion with Felix. What did you take away from it?
Hi, Adam. Good to see you again. Thanks for having me. And yeah, great to listen to Felix. I just got to give you kudos. You got another really esteemed voice to chat with you here this week. Felix has been in the business, as they say, for a long time, a lot of perspective. And look, I think he has had some very astute observations, both in the near term and bigger picture paradigm thoughts. I think what this conversation and many others that you've had, Adam, I think illustrate is that there are many plausible scenarios and paths that go forward from here, and each one is plausible in their own ways. Yet they can be somewhat different paths. For example, Felix believes that we're going to see a more pronounced near-term market decline, perhaps into the summer, and followed by a rally, a change of central bank policy fueled rally, say come summer, and compare and contrast that with, for example, a recent conversation you had with David Hunter, who thinks we're in the early stages of a short but very powerful rally, only to then be met with a big decline. So both were, very, very seasoned, very experienced observers, and somewhat different pathways. They both, incidentally, believe there's going to be a large reckoning to the downside. Both have thrown out declines that could approach 50, 60, 70, 80% even. So there's that commonality between those two, very esteemed voices. But I raise this just to point out that, as much as we strategists want to kind of predict the future, there are a number of plausible paths. And when you get to the application of those futures from the seat of the folks like us here at New Harbor, working with clients on their real money, their real lives, there needs to be a multi-pronged and humility fueled approach, keeping their financial security and goals top and center, irrespective of what the different kind of scenarios play out. All to say there needs to be a strategy that can be okay, not just okay, but satisfactory and successful for each client based upon their own situation, regardless of what pathway plays out here in the near term.
I'm glad you drilled into that, because I've found myself mentioning the same thing recently, where, for the past, since we started this, new Wealthion channel back in April, I would say there was sort of a general consensus amongst many of the guests that we brought on here about what was going to happen. But now, as we're entering 2022, there really is sort of this bifurcation in the near term. Everybody still largely gets to a point where the system really kind of collapses under its current unsustainabilities, and you get a big, the optimists say 30%, the pessimists say 80+%, correction that becomes a prolonged crisis. It's not just a bounce like we had in 2022 there, in 2020 back then. So, you've got very smart people that, at least as they look at the short term, are seeing, a multitude of different options, as you're saying. Some say we're going to go up over the next 6 months until the Fed, changes regime, and then we go down. And then some, like David Hunter, and some like Felix, say the exact opposite. So it really does underscore the need for a risk managed approach, which is, hey, nobody knows with certainty what's going to happen, and even smart people can disagree, at least in the short term here. And so you'll want to have a positioning that makes sure you're okay, no matter which path it happens to be, as reality, unfolds here across the next months and quarters. A lot of our guests, even Felix as well, underscored kind of the need for more active management that we've had in the past. I think it's been a drum that almost every guest that I've had on this channel recently has been beating. But Felix is just adding his voice to that chorus, which is saying, hey, look, you're really going to have to pay attention. You're really going to have to A, be nimble, B, have hedges, risk management in place. You're going to have to react in case things start going against you. These are all reasons, and I know I'm singing from your song sheet here, by which most people probably want to work with a pro who can be advising them during this time, particularly if they have real jobs, and have to focus on a lot of other things besides what the market happens to be doing today. Now, Felix, in terms of what assets he's investing in, and I think one of the important things to note about Felix, in contrast to some of the other guests we've had on this program who are analysts but don't necessarily manage capital, Felix manages billions of dollars worth of capital, and the vast majority of that, I believe, is sort of for his own family. And so, he doesn't have the luxury of just having an opinion. He really needs to be as right as possible, because a lot of money rides in the balance. So very quickly, maybe we'll take these a few at a time, or one at a time, John. But so gold, he thinks will do well in the short term as the market, continues to fall here. But once the Fed reverses policy, as Felix thinks it will, and then the markets run to 2024, even though he said that is igniting the second inflation wave, he doesn't really expect gold to do all that well during that period, kind of the way it's been disappointing a lot of the inflation. The people who own gold, as an inflation hedge, have been a little bit disappointed with it to date. But then when his big collapse comes after 2024, he thinks gold is going to do unbelievably well. I'm just curious, any reaction to that? I know that gold is a fairly important asset that's currently in the New Harbor portfolio.
Yeah, this is a great example to my point of, there are many plausible scenarios, and this specific scenario with gold that Felix illustrates or narrates certainly is a plausible scenario. He did say, in fact, that the next couple of years, maybe through 2024, would be maybe gold be range bound between 1,700 and 2,100 or so, which is kind of not too far off what we've been range bound these last several months, if not year or more. But he did say he thinks it's a great time to be accumulating the position for that later likely rally. But there certainly is a scenario where gold does take off nearer term. But our approach is we look at the data. They're fundamentally undervalued asset class. Much different than most other segments of the stock market. For example, if you're talking about the gold mining stocks. But we do have hedges in place. We do absolutely, with humility, acknowledge there's a scenario where gold could be quite, range bound or possibly even weak if we get a sympathetic selling with broader markets. So we do have hedges in place on our gold exposure for most of our clients. That's just an acknowledgement that the near term could be, a leg down before a much more sustained and large move higher. But yeah, we agree with his longer term. If there's one area that we think folks could be considered or consider a buy and hold area, it's gold and precious metal miners in particular. We think is a proper segment that could be thought of as a buy and hold kind of scenario for the next decade even. Wouldn't say the same for the broad stock market. In fact, most of the folks we talked about, Felix, David Hunter, we talk about Jeremy Grantham, we talk about John Hussman, all these very esteemed people, even though they might disagree on short-term paths, the data certainly supports a conclusion that a buy and hold investment in the broad stock market is likely to go hardly anywhere, if not negative, over the next decade. Speaking again to the importance of tactical changes in risk exposure in the broad stock market in adaptation to what would likely be a very volatile path forward over the next several years.
All right. Thanks for that, John. And one thing that I thought was kind of interesting was, Felix is, she said he's fairly short equities right now, plans to get more short as we go along the next couple of months, if indeed his prediction of a 20% X decline begins happening. At the pivot point, when the Fed reverses policy, he expects that stocks are going to do quite well for the next year and a half, basically through 2024. But what was interesting is he said, so he's going to be short equities until the summer, basically, which is sort of when he expects that pivot point to be. But then at that time, he says, hey, you got to go along the darlings like Microsoft and Google. He thinks that's where a lot of capital go into. But he says you also got to go into the commodity producers. He says that right now he thinks we're only in the second year of this new commodity bull market, and that the phase one run up is almost complete. The next couple months is going to be sort of a phase two down trend, and then at that summer inflection point, he thinks the phase three uptrend is going to explode. And in his one example he gave was he thinks oil could trade down as low as 50, but then go up as high as about 200, right? But what's interesting is he said that phase three run up is going to go all the way from this summer through 2024. And he said, you want to own the commodity producers, including the mining companies. So even though he thinks that gold and silver themselves, may languish a bit during that period, he thinks that the mining complex, as well as all the other commodity producers, energy, ag, base metals, et cetera, are going to do very well. And while that might seem inconsistent to people, it's not terribly so, because the precious metals miners, even at today's prices, are ferociously profitable and cash flow positive, at least the major ones are, in a way that they really have never been before. And so they can still make lots and lots of profit by new exploration, bringing new mines into development, into production, all that type of stuff. But anyways, it's just a way to understand that even in an area where the precious metals themselves maybe remain flattish, the mining stocks can actually still do quite well. And we've had a number of people on the program. I just interviewed Jeff Clark the other day, who sees precious metals as the mining companies as being set for one of their best runs in history. So hopefully from his lips to God's ears.
Yeah, the valuations of the mining stocks relative to the price of metal is still very much undervalued relative to their own history. So the quick takeaway from that, even a metal, bullion price staying roughly the same or even going down a bit, still could afford, a pretty sizable appreciation in the mining stocks themselves, and have that ratio of the valuations in the mining stocks relative to the price of gold still be under historical levels. That's the margin of safety, I would say, that the mining stocks have effectively built into them because of how undervalued they are.
That's a great point. Again, just one of the many reasons that folks have been saying the miners, are looking very well positioned this year. To your point is, hey, precious metals prices can stay where they are. That ratio just needs to mean revert, and there's going to be a lot of additional value creation there. All right, just kind of closing out Felix's thoughts on assets. He thought that bonds are going to, he thinks the bond yields are close to a high. He expects them to drop pretty substantially, in his words, from about 2% down to about 1% by summer when that correction's finished playing out. And that will be, bondholders could make a lot of money during that period. I mean, that's a pretty substantial decrease in the bond yield. But then he says from thereafter, it's basically all downhill for bonds, just higher and higher and higher yields and interest rates as far as he can see. I see you nodding as I'm saying this, but I know you guys don't hold a ton of bonds in your portfolio, but sort of what's your reaction to Felix's bond outlook there?
Yeah, we're actually very much of the same mind. In fact, we're getting in the zone, we think, for a possible tactical trade, short-term tactical trade in some, longer dated treasury bonds, because we do believe they're in the short term here, yields are getting, a little bit extended, and likely we'll see a reprieve back. And certainly, I think if there's a policy shift in the central banks, like Felix kind of plays out a logical scenario, perhaps by the summer there's a policy shift. We think that could very much, again, fuel a retreat in bond yields, which of course would be supportive to rises in the bond prices. So we're actually getting pretty close to a zone where we're thinking about there might be some actionable tactical long positions in bonds, longer dated treasury bonds. So we agree with that. But again, longer term, we think they're a horrible investment for all the same reasons. I think there's going to be very significant pressure, inflationary pressure, and interest rate pressure that could whack bonds and essentially give back a good bit of the last 30, 40 year of a bull market that we've had.
Right, which, I think very few people can really wrap their brains around it. That's probably one of those things they think can't happen that very possibly could, right? And we've talked about the dangers of confirmation bias on this program in the past. So, Felix said something that was, I think, really interesting, which he's a market cycles guy. And he says that, hey, market cycles have been pretty suppressed over the past decade plus by the central bank's extreme and historically unprecedented interventions. But he thinks that that era is coming to a close, maybe even has sort of come to a close. We've seen a lot more volatility come back into the market this year. I think that's a sign of that artificial tranquility being over. And so, it sort of sounds, John, from what you just said, you guys are looking at this next short-term cycle in bonds and saying, hey, yeah, this actually may offer enough of an opportunity that we may actually want to try to play this next short-term cycle. But beyond that, we're pretty darn pessimistic, and we're probably only going to be in that trade until it hits our target, and then we're probably done. Is that correct?
I think that's fair. And one point I want to make, and Felix gets this because he's managing money like we do for clients. We can talk about scenarios where even you get down to the month of predicting a bottom or a top. What I think anybody that's truthful with themselves and to anybody they speak to would have to freely admit is we can talk about that scenario, but actually getting it right and actually being that precise is near impossible. It is a stroke of luck. So the idea that you're going to have this precise, get in at the bottom, out at the top, and this and that is just a fallacy that only a few will luckily be able to do. So my point being is, even if these percentage move forecasts come to bear, the actual ability to harvest those gains and avoid those losses with precision is a near impossibility. And that's why, it's really important to think about hedged approaches, because you can use hedging tools to kind of, position for that kind of scenario if that's what your thesis is. But essentially neuter the sting of being wrong or imperfect on timing by bounding the risk parameters. And for example, we use a lot of options in appropriate ways for our clients, and I wouldn't at all give personalized financial advice here, but a client that wants to participate in a thesis or a scenario like we've talked about with Felix or like David Hunter has, there are ways to position that way, but put some very bounded controls on risk. And there is no free lunch. When you're hedging, you're giving up something. You're either paying for downside protection or foregoing some of the thesis on the upside that you might have. But point being, it won't be a game over event if you put hard bounds. And that's the real value of hedging, because there is no perfect timing of these scenarios. They may come out to play, but you could be off by months, and you get out at the wrong time, in at the wrong time, and it can make all the difference, right?
Yeah, it's a really important part, underscoring the risk management that we're talking about. I want to complement that with when you work with an advisor like you guys, or it doesn't have to be you guys, but somebody who's conscientious and conservative and somewhat skeptical has a healthy skepticism that everything's going to play out exactly the way that you think. What you offer clients, an advisor like you offers clients, is the ability and the discipline to kind of take emotion out of the equation, right? So as you get close to the targets that were why you put the trade on or made the investment in the first place, a lot of times our human emotions say, wow, this thing's a much better, horse to ride than I initially thought. Wow, I wonder how much further it can go. And all of a sudden, that plan you had at the beginning, you start kind of shifting, the goal line on it, right? And a good advisor can say, well, let's take a look at the fundamentals and see if anything changed here. Because if it didn't, you begin to put yourself at risk by reaching for this, dream of further riches, you're maybe much better off taking the safe route and selling the gains that you have here and then making another smart call, right? So there's the sort of the discipline of the plan and the antidote to emotion, right? Also, an advisor does a good job too, I think, of for most people, being able to watch the environment and how it's changing, and to be able to say, wait a minute, we had this plan going in, but now with these new developments coming in, they actually are revealing that some of our initial assumptions don't apply anymore, and maybe we need to take action now because we're entering a different environment than we actually created this plan for. Right. So I see you nodding as I'm saying all this, but those I think are additional ways, sort of on top of the base risk management with hedges, that basically putting a good plan together and working with somebody who can be your emotional foil there can really help add.
Absolutely. Yeah, absolutely. And we're human too, and we try to keep in check our human instincts, or bad instincts at least, by the data. So anytime we enter a position with discretion for a client, we always have a game plan, both on the upside and the downside. An exit on kind of the upside target being achieved, or at least resetting, based upon data, what that upside target would be. But we also have an exit plan. If things don't work out, we either have hedges in place or a sell discipline. That is really important, and we make note of that. We hold ourselves to it so that we can really challenge ourselves. And that, as they say, it's easy to buy, it's hard to sell, right? If you don't have a guiding process, a guiding discipline, the sell part can be immensely hard. Unfortunately, the sell part becomes easy for a lot of people after they've written something down, 40, 50, 60%, and they sell because they're desperate. They think it's going to zero. And that's where, the lack of discipline can really be damaging for many folks.
All right. Well, look, wrapping things up here. The markets have been, doing very well the past week or so. Prices are, pretty much jumping day after day here. Talking about sort of how not all, almost no predictions come to pass completely accurately or on the exact dates that people talk about. I do just want to give a little bit of sunshine to David Hunter, who did, pretty much when we had him on this program, say, hey, I think the market's bottoming here, and I think my melt up's, just about to start. The market pretty much has been going up ever since he said that, not saying that his, crazy melt up from, S&P, I think at the time he said it was around 4,400. It's going to 6,000 in the next couple of months. Maybe it will, who knows? We'll be watching it here. But we are seeing the markets begin to march up here, which is really kind of interesting because tomorrow we're going to get the latest CPI data. I don't think anybody's inflation fears have really gone away all that much right now. The Fed is still saying it's, at least hasn't updated its forecast of the multiple rate hikes, because it plans to start doing pretty soon. So something is giving this market, the confidence to grind higher here. So if you can just give any commentary you want about what you see happening in the markets right now with prices raising here. And secondly, just speak to the emotional state of the people that you're talking about these days, both clients and people that are calling you to learn more about you guys. Are people becoming more optimistic? Is FOMO creeping back in? Just sort of what's the general state you think that people are in right now? And are there any advice you have for people if you think people are maybe coming to some poor emotional conclusions here?
Yeah, sure. So on the market action, we reached, we had a kind of an oversold condition a couple weeks ago. We were talking about, David was talking about it, kind of likely bounce there. Lance Roberts, who's doing the weekly recaps, talked about oversold, likely bounce. And those are all, very, very, kind of visible technical support levels. If you look at the kind of short-term moving averages, for example, a couple of weeks ago, we were right at kind of the, lower Bollinger Band of the 50-day moving average on the S&P 500, which is essentially like 2 standard deviations oversold relative to that moving average, as the technicians will speak to it. And so there was statistically a pretty decent likelihood of a bounce there. And that also went back to some support that was back in October of last year. So there was some very short-term technical programmatic support for a likely near-term bounce. And we bounced up to about the 50-day moving average a week ago. and the market immediately repealed back a bit, a couple 2-3%, I think. And here we are today, a week later, and we've bounced back to that roughly that 50-day moving average. We've kind of poked above that a little bit. So, this is not at all a typical behavior for a market that has possibly changed direction. So while David's near-term prediction certainly seems to have been prescient, it would not be without precedent that things start to stall again here. Again, this is not a guarantee by any stretch, but I'll say that this recent bounce is, certainly is consistent with a short-term technical, bounce that I would say was a decently high probability. Of course, where we go from here remains to be seen, and I think any scenario deserves caution, because even David Hunter's round trip scenario calls for a negative 65%, cumulative loss if you just buy and hold. So again, that precision and tactics, and David would be the first one, Adam, and I think he was pretty open about this, that his job is not to tell people how to invest. His job is to talk major cycles, and he I think puts the adequate caveats as to when it comes to investing. His forecast really shouldn't be thought of as a prescription for how to invest down to the month or the day or the pinpoint, but just a vision or a pathway for what likely could happen from a sentiment contrarian indicator standpoint.
Yeah, absolutely. And David, I think, reminds people of that almost daily on his Twitter feed. All right, great. Thank you. And just getting to my second question there, what's sort of the mood of the people you're talking to right now? Because you guys are, I feel, really at you're closest to the pulse of what the average retail investor is thinking. And, I know a lot of times you guys have had to kind of talk people down from the heights of FOMO at certain times. You've had to bring them up sometimes from the depths of depression. What are the main things that you find on people's minds right now?
Yeah, it's mixed, right? Each client, each person, it has their own set of situations or circumstances, or people they hear at cocktail parties talking about this or that as relates to their own portfolios. But I would say, certainly there was an angst that was palpable late last year of people feeling like the markets were just going up and they were being left behind. That has very visibly, we have, in the conversations we're having, that tone has been much more put in check with the weakness this year. And people just, even folks that don't really follow markets, that are just good people that care about their financial, they don't want to miss out on opportunities, but they also kind of understand the concept that not everything can be trusted, and time and time again their guts tell them that, hey, these swings in markets aren't an all clear for, hey, that was the worst of it. Most folks are coming to us or talking with us that we think it's just emblematic of more challenge to come in markets, and we're happy being very defensive. We are having some very individualized conversations about people that want to kind of take some more risk. They're few and far between. Frankly, most of our clients want to be on the very defensive side, but for those that want to take more risk and possibly play a scenario like what David Hunter talks about, there's ways we can do that, and we've talked to them about any number of tools we have to inch their risk out on the spectrum, but also put some balance on what that looks like, and most importantly, what kind of downside protection we can build in for them should that scenario not play out.
All right, great. I always love hearing sort of your from the field lines, firsthand intelligence there, John. So thanks. All right. Well, look, as we wrap up here, we've got now some conflicting calls from a number of our different experts about what's going to happen here. Some think we're going to decline into summer and then bounce, and some think the exact opposite. Well, now that we're in February, we're not going to have that much longer to wait. We're going to see it unfold over the next couple of months here. For folks that are watching and understand the message that Felix delivered of, look, this is going to become a much more active management demanding environment. There's going to be a lot more volatility. These cycles are going to become much more important. You're really going to have to watch things much more closely. If you do not have a good financial advisor to talk with and to be your quarterback through all this, John and Mike They offer free consultations to all Wealthion viewers. If you want to just talk to them about your personal situation, they'll be happy to sit down and do so with you. So if you want to schedule a conversation with an endorsed Wealthion financial advisor, again, for free, no strings attached, no pressure to work with them at all. Just stick around at the end of this video. It's coming up in just a couple of seconds. We'll tell you how to do that. It's really quick and easy to set one of those up. And if you like seeing great guests on this program, like Felix Zulauf, do me a favor, support this channel by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. And John, whatever happens next, we'll be watching it very closely and reporting back to it on this channel for folks. Thanks so much for joining me this week, and everybody else, thanks so much for watching.
Thanks again, Adam. Great to be with you, and we'll see you next week.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.